Hello and welcome to the Business Today show. I'm Uday Mukherjee. Today on the show we're going to talk about global financial markets with the legendary investor Mark Mobius. Mark, it's wonderful to have you on the show as always. Perhaps you could start by explaining what's going on with this pullback rally that we're seeing across global equities. I mean, from the lows of March we've had a significant rally, and all around there's been so much gloom and pessimism. What do you think is going on here?
Well, it's all about money supply. As you know, the Fed in the U.S. has been trying to pull back on money supply, and they've been doing that, and they've been raising interest rates. But in the meantime, there's still an awful lot of money left out there. And one of the things that's happening is that people are finding that with higher interest rates, they can put their money to work on fixed deposit instruments, bonds, who are paying a higher rate, and also this extra cash they get can be put in the stock market. So it's really a sort of a respite from what's been happening with the money supply. So we expect money supply to continue to decline, but not at the rate that it was earlier this year.
So would you classify this as a relief rally or something more durable than that?
I wouldn't call it a relief rally necessarily, but I would say that we're in a better shape than a lot of people think we are, simply because there's an awful lot of money being spent by the U.S. government to begin with on such things as space, on such things as semiconductors, and a number of other areas. So I think that means that the economy is a lot better than people imagine, and as you know, employment is at a good level.
So you're not in the camp which believes that the US economy is hurtling towards a pretty bad recession, because all this, the news from the banking sector over the last couple of months led people to believe that such bank failures typically occur before the US goes into recession. Do you think that's not the right way to think?
No, the bank problems were simply the fact that interest rates went up. The banks were holding long-term maturity bonds, which were losing value. And there was a panic created by the fear that these banks were not able to make good on their deposits. That's over now. The Fed has moved in very aggressively to help the banks. And they have supplied money to the market in order to ensure that happens. That has nothing to do with the health of the economy. Health of the economy is really based on what's happening in the industry and service industries as well. And with the government spending an awful lot of money in a number of directions, and with unemployment at a relatively low level, we think the U.S. economy will do fairly well this year.
And would that translate into a positive return from the stock market too, you think? Because I mean, till even last month, most analysts seem to believe that this will be a difficult year to make any kind of positive returns from equities.
Well, the stock market actually reacts ahead of what's happening in the economy. And of course, you know, they were expecting a downturn as a result of these problems with interest rates. So the market already has had this correction. I think going forward, the market is telling us that it's not completely certain that the economy doing well, but it's certainly not telling us that the economy is doing badly, because you can see the market has recovered a little bit, and there's sort of a sideways movement in the market, which indicates that the expectation is that the economy will do fairly well going forward.
So if you had to bet, would you bet on the fact that most of the bad news is already in the price for equities, or would you bet on the fact that things get worse from here on as the year progresses?
Well, it will depend on where the debts are. In other words, those companies that have heavy debts and no cash flow are going to be in trouble. And that's the reason why a lot of the tech companies are looking at problems. And one of the reasons why that semiconductor bank in Silicon Valley did so badly, because there was the expectation that a lot of their clients would not be doing very well, because you must remember, a lot of their clients were really not earning that much and were requesting more and more funds to expand. That is over now. and you have to see these companies doing well. It's the companies that have no debt or very little debt and good cash flow. Those are the companies that will survive. So the market will be very divided. It'll be quite interesting to see which companies do well and which companies don't do so well. And I think the deciding factor, of course, will be debt.
Where does that leave the Nasdaq, Mark? Because opinion is very divided. Some believe that it has put a bottom in place and we are not going to revisit those lows again. Some believe that the debt issue that you are alluding to will see the tech companies get into trouble because interest rates won't come down in a hurry, and we'll see some of those stocks go back to their lows again. Where do you stand on the Nasdaq?
Well, there's no question with the Nasdaq. You have a mixture of companies that have very good cash flow and low debt, and some companies that have high debt or no cash flow at all. Actually, the Nasdaq probably will not do very well because many of those companies in Nasdaq are in that latter category. In other words, they're companies with big expansion plans, but very little profitability coming in, and relatively high debt, or at least a need for more and more cash to keep the operations going. So a lot of these companies will fall by the wayside, and that's the reason why Nasdaq probably won't do that well.
You know, this whole issue is playing out in a different way in the Indian market as well. I mean, we are talking about the issue of debt and high interest rates. I mean, you're of course aware of the kind of problems that one of the larger groups here, the Adani Group stocks, have faced over the last couple of months. I mean, as a global investor, how did you see that problem? What did you take away from it?
Well, first of all, there's no question that the Adani Group has some incredible assets. And if you know that some of these assets are quite irreplaceable, they're quite valuable going forward. The problem with Adani, of course, was the debt. The debt levels were too high. One of the reasons why we stayed away from Adani was because of this high debt. But being so big, you know, if you, as the saying goes, if you are very big, you're not in trouble, the banks are in trouble. So the banks are going to have to support Adani in order to ensure that their assets come back. But as you know, there are some investors, particularly Rajiv Jain in the US, who's put quite a lot of money in Adani because he felt that they're incredible assets. And in the long run, this will go well. So my feeling is that probably the whole thing about Adani was overblown by the Hindenburg Group, because they have their reasons for, you know, if you're shorting stock, you want all the bad news to come out. But I don't think the reports by Hindenburg were completely accurate and on target. I mean, everyone knew that the family was involved in the company. There's no secret about that. And a number of other things they supposedly revealed were pretty well known by analysts. But the fact remains the debt levels were just too high.
Yet, as an investor, you've not, I mean, you're saying that the issue is overblown, but you've not found the opportunity to walk into any of the group companies yet?
No, actually they're a little bit too big for us. We tend to focus on smaller companies, medium-sized companies, and we have a pretty strict rule. We don't want companies with high debt. If a debt equity is higher than 50%, we don't invest.
Right. Now, other than Adani, which has a mountain of debt, there is another problem which is played out in India, which is that the new age digital companies, which you were referring to earlier, I mean, they don't have debt, but they have a lot of recourse. I mean, they've built their companies on private equity, and the source of that has been drying up. Have you had opportunity to look at any of these stocks because of the severe price correction they've seen, or do you remain skeptical of how many would survive this winter of venture capital funding?
The latter. I think we have to be skeptical about many of these companies. You must remember that as an average, 1 out of 20 companies, startups survive. And in the tech area, you know, we've been in this period of very, very loose money, no interest money, or very, very low interest money. So a lot of people have been throwing money at these companies in the hopes that one day they will become another Amazon or another Google or whatever. And of course, a lot of these hopes will be dashed. They will not come true in this era of high interest rates. So I think you have to be very cautious about that space. Of course, many of the private equity companies still have cash and they have a long-term view. They're willing to wait. So they will finance some of these companies, but maybe 1 out of 10 will be successful, if that.
Okay. Now, from your perch as a global investor, how have you read the relentless selling from global investors in India? I mean, for the last many months, our market has been held up by local investors, but foreigners have been selling relentlessly. But do you see that abating anytime soon and the foreign money coming back?
Yes, I think it will. As soon as confidence returns in the U.S., in other words, as soon as the U.S. market comes up dramatically, then people will be looking at India again. There's no question about that. In fact, they'll be looking at emerging markets generally. Actually, emerging markets have been doing fairly well recently vis-a-vis the U.S. market because there are many of the large investors that want to diversify out of the U.S. And so that's been a plus for emerging markets. But I think the interest in India will return, no question about that.
Yet there's been a lot of talk about the money going to China because of the gap in valuations, reopening of China this year, etc. But how do you see these two? Because you track both carefully. But between China and India, what will suck in most of the emerging market capital which is coming back?
You must remember, China has a number of advantages at this stage. As you know, China underperformed India dramatically in the last few years, and now it's beginning to turn. That's number one. Number two, the Chinese market is very large and very liquid. If you compare the market capitalization of China versus India, you'll see that there's a huge difference. So for the large institutional investors, they really don't have much choice but to go to China. So if they have a basket of emerging markets funds, they might put 10% in India and maybe 40% in China. So you can see that China is still very attractive from that point of view and will continue to be so.
Is oil a factor at all, Mark? Because, we have this issue of crude imports and crude prices have started moving up once again. I mean, do you have a view that crude climbs above $100 once again? And if it does, where does that leave this India versus China question?
Well, the good news for India is that they can get cheap crude from Russia as a result of what's happening in Ukraine. So I don't think that's going to have a big impact on India, even if crude does go up. Crude, of course, is not going to go down dramatically, that's for sure, because the demand for crude, the demand for energy generally, as you can see from coal prices, is still very high. But I think India will still be in a good position because of what's happening in Ukraine and the lower supply going to Europe and the higher supply going to places like India and China.
So what is the best way to approach India right now, Mark? Because valuations in pockets are quite steep. I mean, with any global comparison. I mean, people are talking about capex coming back, but many of the capital good companies have become very expensive. So which pockets do you bet on in India when you look at it relative to valuations?
Well, it depends on how you define expensive. I personally don't think price-to-earnings ratios are a very good measure of value. I personally like to look at return on capital, return on equity, cash flow, etc. And if you look at those measures, India is not really that expensive. So there's still plenty of bargains in India. And when you consider that India is growing at a very, very high rate, the economic growth is high, and therefore the potential for earnings per share growth in the companies in India is very high as well.
Okay. And many of the stocks in India which have actually performed very well over the last 1 year are typically companies which, large global investors may turn their nose up at. They are these smokestacks like NTPC and Coal India. There are these sin stocks like ITC. There is this erstwhile forgotten public sector banking stocks. I mean, if you did not own that end of the market, you wouldn't have done very well with your portfolio. How do you see this change where many stocks have actually been flying in the face of the faddish concepts like ESG, which were ruling the roost last year?
Yes, I think the variety is incredible. And the good thing about India is you do have a wide variety of stocks and sectors. We are involved in the software sector, medical sector. We're in the industrial sector as well. So there's lots of things you can pick and choose in the Indian market. And of course, depends on what your mandate is. As you know, the whole ESG emphasis is beginning to change. People are beginning to question whether investing according to ESG criteria is a good idea. So that will probably be another factor that will be positive for India going forward.
And just to get the discussion back to the global sphere again, I mean, the jury's out on how the Fed moves from here on, because some are saying the banking crisis is a call for the Fed to slow down or even stop. Others saying no, they're really focused on inflation and they will not let the banking crisis deter them. What do you expect to see from the Fed over the next few weeks and months?
Well, you must remember the mandate of the Fed is to crush inflation. And they have a target of 2%. And as you know, the inflation rate now in America is something like 5%. So they've got a long way to go. And they believe, in order to crush this inflation and bring it down to 2%, they believe that they have to raise interest rates. So I think you will see a continuously higher rate of interest coming out of the Fed decisions. Of course, a lot of that will probably be delayed until the election. As you know, the Fed is a political organization, and they will want to make sure they don't kill the democratic goose that lays the golden egg. So they may want to hesitate before they raise rates too much, but still the objective is the same. 2% is the number, and that's where they're going.
So do you expect them to raise rates a number of times from here on, or would it rather be a case of them raising a little bit more, but then actually holding rates for maybe another 9 to 12 months at that elevated level? So there is no great Fed pivot, as they call it, happening anytime soon.
Yeah, it will be a lot slower, and they've already signaled that. They will be much more cautious. They'll do it more slowly, maybe 0.25% here, 0.25% there. And they will be watching carefully to see if the inflation rate is coming down. But at the end of the day, those rates will continue to go up unless inflation comes down.
And you think equities can climb in a situation or a backdrop like that, where interest rates remain that elevated, say 5-6%? You think companies, banks, etc., corporations can handle that?
Well, history shows us that high interest rates do not kill the stock market. There are many, many cases, if you go back, when interest rates were high and the stock market was doing very well. So I would not say that there's a direct correlation between high interest rates and a bad stock market. In fact, maybe the opposite.
And where does all this leave gold? Because gold has been on a bit of a tear. It's been one of the best performing assets, now above $2,000. Does this continue to outperform most asset classes, you think?
Yeah, I think gold, I've been recommending gold for quite some time as a safety hedge. And I think they're going to continue to do well, but there'll be corrections along the way. So, it's maybe a good idea when gold goes up like this, take a little money off the table, but keep that 10% in gold. That makes a lot of sense.
Mark, always a pleasure hearing your thoughts. Thank you very much for taking time out today.
Thank you. It's a pleasure talking to you.